Global financial markets are currently reacting to a 3-week escalation in Iran. This geopolitical conflict has introduced a level of chaos into the trading day but is overriding standard market logic. The source of that volatility is this narrow passage, the Strait of Hormuz. 20% of the world's daily oil traffic moves through this single corridor, making it the most sensitive energy bottleneck on the planet. When the United States reports progress on negotiations, oil prices drop and markets rise. But when the Iranian regime refutes those claims, the prices spike back up immediately. This erratic behavior occurs because the market is attempting to price in the physical threat to global supply. As long as these tankers face the risk of a blockade, the uncertainty remains embedded in the price of every barrel. The stock market's extreme bipolar movements map directly to the status of this unresolved geographic choke point. If the Strait of Hormuz is obstructed, the resulting drop in oil supply forces global energy prices to spike. This creates an immediate ripple effect throughout the economy. Higher fuel costs drive up the expense of manufacturing goods and moving them to market, which raises the baseline rate of inflation for consumers. In a typical economic slowdown, the Federal Reserve would lower interest rates to provide the market with more liquidity and prevent a crash. However, elevated oil prices create an inflationary recipe that locks the Fed out of its primary toolkit. Lowering rates while energy costs are spiking would risk permanent inflationary damage to the dollar. Until oil prices stabilize, the Federal Reserve is effectively paralyzed and unable to use interest rate cuts to support the stock market. The market is currently factoring in the risk of a return to the 1970s, an era defined by high inflation, rising energy costs, and a weakening economy. This historical precedent comes from Paul Volcker, who was forced to aggressively hike interest rates to record levels to break the back of that era's inflation, regardless of the immediate economic pain. When rates rise to that degree, the money supply shrinks and borrowing costs for businesses become prohibitive, which historically triggers a recessionary cycle and a corresponding market crash. Today's violent market swings reflect the current attempt by algorithms and investors to price in the possibility of this 1970s cycle repeating. Navigating this fear requires understanding pain bias, the psychological reality that losing a dollar creates a negative emotional impact twice as strong as the positive feeling of gaining one. This diagram contrasts the century-long life cycle of the U.S. stock market. While bear markets average only 1.5 years with a 35% loss, the bull markets that follow average nearly 5 years and deliver 180% gains. Historically, a lost decade of zero returns only occurs in 5% of cases. More significantly, over every 20-year period in the history of the S&P 500, the index has ended with positive returns. During periods of global chaos, international capital systematically flows out of unstable regions and moves into the United States. The U.S. remains the primary destination for this capital because it is the largest exporter of petroleum and maintains control over the world's reserve currency. Betting against the U.S. financial system during a crisis ignores both a century of market data and the structural advantages inherent in the global reserve system. There is a specific historical pattern that emerges when a major war begins while the market is near all-time highs. This data tracks a reliable cycle. An initial sharp 30-day dip, followed by an 18-month recovery to previous highs. The highlighted zones represent the optimal period to accelerate dollar-cost averaging and buy the dip before recovery begins. Executing this requires a portfolio built on broad market index funds, with at least 40 to 50% of capital allocated to the S&P 500. Picking individual stocks during a supply shock is mathematically inferior to relying on the historical resilience of the entire U.S. market. Investors build generational wealth by maintaining empirical conviction in buying the broad market while the rest of the world remains paralyzed by fear.